Hey, do you watch Shark Tank reality show? The sharks are looking for the best products and businesses a country has to offer. Hopeful entrepreneurs come to the Shark Tank seeking an investment to start, grow, or save their businesses. If the sharks hear a great idea, they are ready to invest using their own money and they will fight each other for a piece of the action. But first, the entrepreneur must convince a shark to invest the full amount they are asking for. However, great part of the public can't understand business terms used by the sharks when asking questions about a business. In this class, I'll show you 5 business terms used very frequently by them, so let's have a look. Hi everybody, this is Rodrigo from Learn English Fast, and this class was designed to help you better understand the terms that you will come across daily while running your business, working in a multinational, or even dealing with your accountant and your bank. So here is the first term: angel investor. So an angel investor is a wealthy person who invests his or her own money in a company, usually a startup, and that is in the early stages of development. In other words, they are private investors focused on financing small businesses ventures in exchange for equity. Unlike a venture capital firm that uses an investment fund, angels use their own net worth. Furthermore, they expect to take ownership positions in the companies they support because their capital is unsecured. They have no claim on the company's assets. The angels' goal is to help businesses get established, and they also tend to have clear exit strategies for ending involvement with the business. Our second term is break-even point. The break-even point is achieved when a company's total costs equal its total revenue. The break-even point is calculated by dividing the company's indirect costs by its gross margin. Indirect costs are costs not directly associated with the production. When sales are higher than the break-even point, the company has a profit. But when sales are lower than the break-even point, that is a loss. So dividing indirect costs by gross margin provides the break-even point in any currency, whether it is reais, pounds, dollars, euros, right? And dividing that number by the price per unit provides the break-even point in units sold. Our term number 3 is EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is the primary calculation used to determine how much of a company's cash flow comes from ongoing operations. It's an important indicator of the health of a business. The EBITDA is calculated from contents of the income statement using the following formula: net profit plus interest plus taxes plus depreciation plus amortization. The EBITDA can be either positive or negative. A business is considered healthy when the EBITDA is positive for a prolonged period of time. Even profitable businesses, however, can experience short periods of negative EBITDA. Bankers and other finance professionals use EBITDA to decide how much money they are willing to lend a company. And they may use other measures as well, but EBITDA is one of the strongest and most consistent measures. EBITDA is also used to help determine the value of a company. It's used to assess a company's ability to pay its debts and to determine the ability of a business to generate surpluses for the activities like paying dividends, all right? Our term number 4 is hedging. Companies use hedging to minimize the impact of potentially negative financial events on their business, such as unexpected spikes in value of foreign currency or the price of raw materials they use to make their products. In other words, it protects an individual's finances from being exposed to a risky situation that may lead to a loss of value. However, hedging doesn't necessarily mean that the investments won't lose value at all. Rather, in the event that it happens, the losses will be mitigated by gains in another investment. For example, let's talk about orange juice companies. An orange juice company depends on a regular, predictable supply of oranges, and to protect itself against a possible increase in orange prices, the company could enter into a future contract that would allow it to buy oranges at a specific price on a particular date, and that contract is a hedge. So there are 3 facts about hedging that we need to know. First, hedging does not prevent a negative event from happening. It just lessens the problem, it lessens the blow, alright? The second one is that you need to pay for the benefit whether you receive one or not. And the third one is that sometimes you benefit from what you spent, but sometimes you don't, alright? And our last term of the day is joint venture. In a joint venture, 2 or more companies join together to collaborate on a particular project, and through their collaboration, the companies share resources, losses, profits, and expenses. And this joint venture is a legal entity completely separate from the other company's business interests. For example, let's say if 2 companies form a joint venture to work on let's say a housing development, their other projects and properties are certainly not involved. And before proceeding with a joint venture, managers of participating companies should clearly define how their joint venture will work and what each will contribute. The structure of a joint venture can vary depending on the partners and on the project, and that will have legal and taxes implications, surely. So guys, thanks for watching. I'm going to ask again, subscribe to my channel, click on the button below, make sure you get all your friends to join us so they can get all my tips for international certificates such as GMAT, GRE, TOEFL, Cambridge and IELTS. So I see you guys, hope to see you next time. Cheers, bye for now.